Tokyo at 2 a.m., New York time. A wall of screens, red candles on Japanese bonds, and one number blinking like a warning light, 4.0%. Because when Japan's safe bond market starts moving like a meme stock, the entire global money machine begins to shudder, and silver doesn't just rise, it gets forced higher. Today, I'm going to show you how the collapse of Japanese bonds is forcing silver toward $103, not because of hype, not because of a headline, but because a hidden plumbing system is snapping under pressure, and if you understand the chain reaction, you'll stop watching silver like a chart and start watching it like an emergency exit sign. 4 steps. The 40-year yield, jitter. The yen carry, trade implosion. The credibility shock, taxes, deficits, and bond vigilantes. The contagion, Japan, treasuries, and the global rate quake. Then we end with the simple reason silver prints $103 in this environment. Let's walk it like a story. The 40-year yield, jitter. Japan invented the modern idea of boring money. For decades, Japanese government bonds were the zero volatility anchor, the place where time goes to sleep. But earlier this week, the 40-year JGB yield broke above 4%, a level it hadn't seen since that maturity even existed. That sounds like a tiny number to the untrained eye. 4%. So what? Here's what. When a super long bond moves, it doesn't move like a normal bond. It moves like a wrecking ball, because duration is basically leverage built into time. A small yield jump on a 40-year bond can translate into a brutal price drop. And when that happens, the players who assumed calm forever get margin called. So the market doesn't just reprice. It panics. Dealers widen spreads. Liquidity disappears. And the so-called risk-free asset becomes a risk event. That's the jitter, not a slow drift. A violent shake that tells the world the anchor is gone. And the moment the anchor is gone, big capital starts asking one question. What do I own that doesn't depend on somebody else paying me back? That's counterparty risk. And the cleanest answer in a world of shaky paper promises is physical metal. Gold gets the headlines. But silver has a second engine. It's not only money, it's a critical industrial input. So when the safest paper in the world starts swinging, silver inherits fear and necessity. That's step 1. The convexity trap in plain English. Let me translate what just happened in bond language into human language. When yields rise, bond prices fall, but on ultra-long bonds, the fall accelerates. It's like pushing a shopping cart downhill. At first it rolls, then it starts to run. Then you're sprinting after it, praying it doesn't hit traffic. That acceleration is convexity, and in Japan's long end, convexity is a monster. Here's why it matters. A huge portion of the long-dated JGB market is held by insurers, pension pools, and banks that live on stability. They don't trade for fun, they match assets to liabilities, they assume the range is narrow, so when the 40-year yield snaps higher, 3 things happen at once. Mark-to-market losses explode, risk models scream volatility, and hedges become mandatory. Those hedges are not philosophical, they are mechanical. A desk gets a call, reduce duration, raise cash, now. That's when selling becomes contagious. Not because everyone agrees, because everyone is forced. And forced selling in an anchor market is how you get a global tremor. Why a bond shock lifts silver, the 60-second mechanism. People ask, why would Japanese yields have anything to do with silver? Because silver is priced in the language of confidence. When bond volatility spikes, 2 pricing engines wake up. Engine number 1, currency hedging. If the yen becomes unstable, global portfolios hedge currency risk. Hedging flows into instruments that benefit from currency uncertainty. Hard assets are the oldest hedge on earth. Engine number 2, policy expectations. When yields surge, markets start pricing the likelihood of backstops. Liquidity injections, balance sheet support, quiet interventions. Backstops are often inflationary over time. That's the bet. Even the expectation of them makes paper feel less permanent, so metals get repriced as insurance. And silver's insurance premium is unusually sensitive because the market is small. It doesn't take much new demand to move it a lot. Why silver, specifically, can outrun gold. Gold is the king of fear, but silver is the king of squeeze. Gold is a massive ocean. Silver is a narrow strait. Now add the industrial reality. Silver isn't sitting in vaults forever. A lot of it gets used up. Electronics, solar, data infrastructure, medical systems. Some returns, much doesn't. So when money flees paper and industry still needs supply, silver becomes a two-front market. That's how you get these impossible prints. It's fear pushing from one side and necessity pulling from the other. If you're still with me, here's the one sentence you should write down. When the bond market becomes the crisis, the definition of safe changes. That's the regime shift. Not rates up, not rates down. But the anchor is unstable. And in that regime, silver is not being loved, it's being needed. The yen carry trade implosion. Now, the real trapdoor opens. For years, there was a simple global cheat code. Borrow cheap yen, buy higher yielding assets elsewhere, collect the spread, repeat. That's the yen carry trade. It's not one trade, it's a habit, a structure, a pillar. Estimates put it in the neighborhood of $1 trillion or more in various forms. And that number matters because when the carry trade unwinds, it doesn't unwind politely. It unwinds like a crowded theater when somebody yells, "Fire." Here's the mechanical part. When Japanese yields rise, holding yen stops being free. The currency can strengthen, funding costs can rise, and leveraged positions funded in yen suddenly look toxic. So what do traders do? They sell what they can, not what they want. They liquidate. Stocks, bonds, credit, EM, anything with a bid. That liquidation is a liquidity drain. And it has two immediate side effects. First, it creates forced buying of yen, which increases volatility. Second, it forces global players to de-risk fast, which stresses every market tied together by leverage. Now here's the twist. In a classic unwind, everything gets sold at first. Even metals can dip for a moment. But in a sovereign credibility shock, where the problem is the bond market itself, the safe destination changes. Because if the stress originates in government debt, running to more government debt feels like running deeper into the maze. So capital looks for an escape hatch that is liquid, globally recognized, not a liability of a government, and not trapped in one jurisdiction. That is where silver becomes a magnet. Silver trades like a commodity on paper, but it behaves like an insurance policy when trust breaks. And when carry trades unwind violently, the market starts paying up for insurance. That's why you get these sudden vertical moves. It's not just buyers chasing, it's portfolios rewiring. Silver becomes the I need out button. Accustomed to the credibility shock. Now we get to the part people misunderstand. Bonds are not just math. Bonds are belief. Belief that inflation will be managed. Belief that deficits will be controlled. Belief that tomorrow will look like yesterday. When that belief cracks, yields don't rise in a smooth line. They gap, they spike, they start behaving like a vote. This week, Japan's 10-year yield pushed into the 2.3% area, levels not seen since the late 1990s. Again, to the casual observer, 2.3% doesn't sound apocalyptic. But in Japan, it's a regime change, because Japan isn't built for high rates. The debt load is enormous, measured in multiples of GDP. And when servicing costs rise, markets start to ask, will this be funded by growth or by currency dilution? At the same time, policy debates have included proposals to cut or suspend taxes on essential goods, while also supporting the economy with additional spending. I'm not making a political argument here. I'm describing how markets read credibility. Bond markets don't care about intentions. They care about arithmetic. If the market believes the arithmetic is drifting, yields rise to compensate. That's what people mean when they talk about bond vigilantes. It's not a conspiracy. It's a price. And once the 10-year yield is breaking decades-long ceilings, the long end gets hit even harder because long-dated bonds are basically a bet on stable decades ahead. So when traders lose confidence in stability, they dump the longest promises first. That's how the 40-year yield crossing 4% becomes more than trivia. It becomes a symbol. Japan's bond market is no longer asleep. And here's why that matters for silver. When sovereign paper becomes volatile, the premium for no-issuer assets rises. Silver is a no-issuer asset. A bar doesn't default. A coin doesn't miss payments. It doesn't have a committee behind it. It just is. That's why silver starts trading like a truth serum. It reflects how much trust is leaking out of the system. The contagion. Japan, treasuries, global rates. Now, for the global part. Japan is one of the largest holders of U.S. treasuries. That's not a rumor. That's the structure of the last 20 years. And here is the nightmare scenario investors have to price, even if it never fully happens. If Japan's domestic bond market is crashing, Japan may need liquidity. Japan may need stability. Japan may need to defend the currency. Japan may need to support banks and insurers holding bonds. Where can that liquidity come from? From selling foreign assets, including treasuries. And even the idea of that is enough to shake the world, because U.S. rates sit at the center of global pricing. Mortgages, corporate debt, emerging market funding, everything. So if Japanese selling pushes U.S. yields higher, the stress transmits instantly. Higher U.S. yields tighten financial conditions. Dollar funding becomes scarcer. Risk assets wobble. More margin calls appear. more forced selling follows. It's a feedback loop, and in feedback loops, the market stops caring about fair value. It cares about survivability. That is why silver doesn't behave like a cute commodity in this moment. It behaves like a lifeboat, because silver sits at the intersection of two fears: currency and sovereign credit risk, industrial scarcity risk. When bond markets wobble, fear number one spikes. When supply chains tighten and industry keeps bidding, fear number two spikes. And when both spike at the same time, the price doesn't climb. It jumps. Why this mechanism? Prince 103 top praises. Now we connect it to the number. Silver's recent surge into the triple digits isn't just speculation. It's a repricing of reality under stress. Here's the simple chain. Japanese long bonds sell off, yields spike, volatility erupts, carry trades unwind, liquidity drains, markets demand higher compensation for holding paper promises, capital rotates into no-issuer assets, and silver, because it's both monetary metal and industrial input, gets the bid. And as that bid hits a market that isn't infinitely supplied, the price can gap to levels that feel impossible the week before. In fact, we've already seen futures trade above $103 intraday. That's not a prophecy, that's the tape. Now, here's the part most people miss. Silver doesn't need everyone to buy. It only needs the marginal buyer to panic about access. The marginal buyer in 2026 is not a guy with a meme chart. It's procurement. It's institutions. It's funds rotating out of duration risk. It's investors who watched safe bonds become unstable. That's why silver at 103 isn't a top by default. It's a symptom of a world where the old anchor is failing. What to watch next? The plumbing checklist. If you want to track whether this move is real and durable, stop staring at one candle. Watch these 5 signals. Japanese long end yields. If the 20-year and 40-year remain elevated and volatile, the stress is alive. Yen volatility. A stable currency means calm funding. A swinging currency means leverage is being shaken out. U.S. yield response. If U.S. yields rise alongside Japan's, the contagion channel is open. Silver's behavior on risk-off days. If stocks sell off but silver holds firm, that's telling you the flow is escape capital, not trade capital. Physical tightness indicators, premiums, delivery delays, and persistent backwardation matter more than your favorite influencer's price target, because the story isn't silver is expensive. The story is paper confidence is expensive. The global financial system is a building made of promises. Most days you don't notice the wiring. You just flip the switch and the lights come on. But when the safest bond market in the world starts shaking, when the yen carry trade unwinds, when yields jump like heartbeats on a monitor, people stop arguing about decor. They look for exits. Silver is not a decoration. Silver is an exit. And that's why the collapse of Japanese bonds can force silver toward $103. Not because Japan controls silver, but because Japan is revealing what paper really is. A promise. And when promises wobble, metal gets louder. If you want, I can do a follow-up where I map 2 scenarios. A stabilization path that cools volatility, and a contagion path that turns $103 into a waypoint. Until then, stay calm, watch the plumbing, and don't confuse a quiet chart with a safe system.